This introduction is intended to provide an insight for accountants and tax specialists into the world of tax indemnity insurance and how it may assist clients. Most insurance brokers will be familiar with warranties and indemnity insurance, and some will have had exposure to tax indemnity insurance. Accountants are less likely to have had dealings in tax indemnity insurance, and specifically the possible solutions it can provide for clients in various situations involving uncertainty with tax issues. Even for those accountants and tax specialists who have previously encountered tax indemnity insurance, it is likely that their involvement is related to sales of companies. While sales are often the catalyst for an inquiry for tax indemnity insurance, there are a wide range of other non-sale situations where it can unlock a tax problem. Typically, tax indemnity insurance operates as a subset of warranties and indemnities insurance. That is, warranties and indemnity insurance is routinely arranged during mergers and acquisitions, and if the due diligence work carried out by the purchaser's advisory team does not identify any specific tax issues, warranties and indemnity insurance is deemed to be adequate to indemnify unidentified future tax risks that may arise. There will be no call for tax indemnity insurance if due diligence has not identified any tax issues. If a specific tax issue is identified, which cannot be resolved by way of price negotiation or deferral of the sale proceeds, then tax indemnity insurance can be the difference between a successfully completed sale and a deal that fails. Areas of uncertainty which have arisen include status of workers. In one particular case, the due diligence process identified a team of workers in a company operating on a self-employed basis. Advisors for the potential purchaser had concerns as to any potential exposure to pay-as-you-earn their client might have post-sale. Their due diligence report revealed a lack of clarity over the contractual position of the workers and their working practices. We were able to work with the company to implement changes to contracts and working practices that reduce the client's exposure to HMRC successfully arguing that workers were not genuinely self-employed. As with all cases, it's unlikely that all risk is removed, but the improvements agreed meant insurance underwriters were able to agree terms for the insurance of an indemnity to cover pay-as-you-earn liabilities for an agreed period. Without the availability of tax indemnity insurance in this case, the sale would have likely involved a reduction in price, deferral of the sale proceeds, or as a worst case outcome, a loss of the sale. Other areas where we've been involved include an option to tax on property, that is, did one exist. Despite the best efforts of advisors, it proved impossible to establish prior to the sale of a building whether an option to tax was in place. After a risk assessment by insurance underwriters, it was possible to issue a policy to protect against the risk of VAT being due on a property sale.